So I want you to imagine waking up every single morning
Okay.
for 39 days straight. You sit down at your desk, you do your job perfectly, and you follow every single rule in your professional playbook to the absolute letter.
Right. Doing everything exactly right.
Exactly. But you end every single day poorer than when you started.
Oh, wow.
Yeah. You don't make a dime. In fact, you just bleed money for 39 days.
That sounds like a nightmare.
It really is. Your confidence just drains, your savings shrink, and every instinct in your body is screaming at you to do something, like anything desperate, just to make the pain stop.
Yeah, just to break the cycle.
Right. And that is not some hypothetical torture scenario. That is the actual brutal, hidden reality of the trading loss streak.
It really is.
So welcome to the deep dive.
It's a profound psychological crucible. And it's a reality that completely shatters the illusion we are usually sold about, professional skill acquisition.
Which is exactly where I want to start today. Because usually when we talk about mastering a complex skill, there's this built-in expectation of linear progression.
Right. You get better over time.
Yeah. If you are learning to be an architect, you lay the foundation, you learn the physics, you build the walls, and the building stands.
And it stays up?
Exactly. Once you know how to build a house, the house doesn't suddenly collapse just because it's a Tuesday.
Yeah, that would be a problem.
Or think about a professional athlete. A major league pitcher doesn't just wake up one morning, walk out to the mound, and completely forget how to physically throw a fastball.
Right. The mechanics are ingrained. They're basically permanent.
Muscle memory is just locked in.
It is. In most professions, skill is treated as a permanent acquisition. You either possess the knowledge to execute the task or you don't.
Right.
And once you cross that threshold of mastery, society basically tells you that you're insulated from total foundational failure.
And we find that idea incredibly comforting, right? We want to believe that mastery makes you immune to falling apart.
Oh, totally.
But then you step into the world of financial markets.
That's a whole different animal.
It really is. Whether you're looking at foreign exchange or conceptually mapping out a Bitcoin chart or, analyzing gold futures, suddenly that comforting linear reality just fractures.
It breaks completely.
Yeah. The landscape of trading is, without exaggeration, just psychologically savage.
Savage is definitely the right word, because what you just described, the athlete forgetting how to throw, that actually does happen in trading.
Wait, really?
Oh, yeah. And it happens to the best in the world. What we're analyzing today is the jarring reality of the protracted loss streak.
So not just a bad day.
No, we aren't talking about a bad afternoon or a single blown trade. We're talking about a deeply disorienting, sustained period where everything you thought you knew about the market,
Right.
and more importantly, everything you thought you knew about yourself, just seems to completely stop working.
Man, so today we are unpacking a reality that the financial influencers, the algorithms, and the broader industry actively try to hide from you.
They really do.
Our mission today is to break down the actual mechanics of the loss streak.
Exactly.
We're going to explore the dangerous psychological traps it creates, the emotional downward spirals that literally wipe out life savings.
It happens all the time.
And we are going to extract the specific battle-tested strategies that veteran traders use to survive these periods without, detonating their accounts.
And we're doing this by analyzing a really fascinating stack of raw confessional source material from 2025.
Yeah, these aren't textbooks.
Not at all. We're looking at actual YouTube videos, real trading statistics, and transparent confessionals from veteran traders. We've got content from Vasily trader Rainer Teo and this highly revealing channel called Dig and Rehab.
And the contrast in our sources today is what makes this so compelling.
It's stark.
Because on one hand, you have the flashy, get-rich-quick side of the trading ecosystem that floods all of our social media feeds.
Yeah, the Lamborghinis and mansions.
Right. And then on the other hand, you have the grueling, unglamorous marathon of actual sustainable trading presented by these veterans.
It's like looking at two completely different realities.
It really is. And if you are trying to navigate this space, understanding the gap between those two realities is, frankly, the only way to survive.
Survival really is the operative word here, because when you hit that streak, if you panic, you accelerate your own demise.
Yeah, you make it worse.
Exactly. You mentioned the pro athlete earlier. In sports, when a player suddenly loses their ingrained mechanics, they call it the yips.
Oh, right, the yips, like a golfer who suddenly can't make a 2-foot putt.
Right, or a baseball player who just can't throw to first base. It's a psychological short circuit.
But in trading, the yips don't just cost you a game.
No, they can cost you your mortgage.
They can white out years of accumulated wealth in a matter of hours. So let's get into the mechanics of this. I want to start by looking at Vasily Trader.
Okay, yeah, let's do it.
The source material outlines a video of his titled, "My Biggest Forex Trading Loss and Win of 2025.
You know, the inclusion of both loss and win in that title is highly intentional.
Really?
Yeah, and we'll definitely need to circle back to how those two things are intimately connected later on.
Right, okay. But looking at his year as a whole, the data shows he had an overall profitable 2025.
He did. By all objective metrics, he is a successful veteran.
Yet he dedicates this entire piece of content to admitting he had one specific terrible period where his core strategy simply did not work.
Let's isolate that exact phrase for a second. His core strategy simply did not work.
Yeah, that's rough.
It is a terrifying concept for the human brain to process. We're fundamentally wired to believe in cause and effect.
Right.
Our entire evolutionary survival is based on recognizing patterns. If I touch the fire, I get burned. If I plant the seed, the crop grows.
So if I follow my meticulously backtested trading strategy perfectly, I will generate a profit.
Exactly. But the market doesn't care about your backtesting.
The market just does what it wants.
And the market is not a simple physics equation. It is a highly complex, infinitely dynamic system driven by macroeconomic forces, algorithmic high-frequency trading, and, well, the aggregate fear and greed of millions of human beings.
Right. So if I'm visualizing a chart, let's say I'm looking at Bitcoin conceptually.
Okay, let's use Bitcoin.
If Bitcoin has been steadily climbing for months, making higher highs and higher lows, that's what traders call a trending market, right?
That's a classic trending environment. And traders build specific strategies to capture that momentum.
So they buy the slight dips, assuming the broader upward trajectory will just continue.
Exactly. They ride the wave.
But then suddenly the momentum dies. Bitcoin stops climbing. It just gets stuck.
Right.
It bounces between, say, a floor of $60,000 and a ceiling of $62,000 for weeks. It just pings back and forth.
That is what the industry calls a ranging market or consolidation. The regime has completely shifted.
Okay, the regime.
Yeah. The underlying mechanics of price delivery have totally changed.
So if Vasily Trader is using a strategy built to capture massive trends, and the market suddenly shifts into a tight, choppy range,
Right.
his strategy is going to trigger buy signals right at the ceiling and sell signals right at the floor. He is going to get chopped to pieces.
He will suffer consecutive losses. But notice the nuance here. When he says his strategy didn't work, he isn't saying he suddenly forgot how to read a chart.
Right, he didn't lose his intelligence.
Exactly. He's pointing out that a strategy failing is not necessarily a failure of the trader. It's actually a mathematical inevitability.
Because market regimes rotate.
Yes. If you trade long enough, you are mathematically guaranteed to encounter a market environment that is perfectly designed to destroy your specific edge.
Wow. So losses are not an anomaly. They're literally the baseline cost of doing business.
They are the rent you pay to be in the market.
But, knowing that intellectually and surviving it emotionally are two very different things.
Oh, completely different.
Because the stakes for Vasily Trader were incredibly high during this terrible period. The outline notes that he faced a significant drawdown, which, for those unfamiliar, means a severe drop in his total account capital from his previous peak.
Right.
But he didn't just experience this drawdown in private. He was broadcasting his losses in real time on his live streams.
That adds a layer of psychological pressure that is almost difficult to quantify.
It gets worse. He suffered the longest losing streak ever seen in his VIP signals group.
Ouch.
I want to put you, the listener, in his shoes for a second. Imagine you've built a community. You have hundreds, maybe thousands of people paying for your expertise.
And they're trusting you.
Right. They're blindly copying your trades because they trust your authority. And every single morning, you have to log on, look them in a virtual eye, and hand them another loss.
That's brutal.
You are actively losing their money day after day.
The weight of that responsibility is just crushing. When you're trading privately, a loss damages your wallet and your ego. You can lick your wounds in silence.
Yeah.
But when you're running a signals group and streaming live, a protracted loss streak damages your reputation. It threatens your entire business model.
And it invites a deafening chorus of external doubt and criticism.
Exactly. Right at the exact moment when your own internal doubt is at its absolute highest.
That feels like the moment that separates the veterans from the tourists. because an amateur in that position would just buckle.
Oh, they'd fall immediately.
They would either shut down the stream and hide, or they would do something incredibly reckless to try and win back the crowd's favor with one massive cinematic trade.
Right. The amateur feels the need to perform. The veteran understands that the market does not care about your audience.
It really doesn't.
Which brings us to a critical concept highlighted in our second source, Rainer Teo.
Okay.
He's another highly established veteran, and his video, How to Deal with Losses, features a specific chapter titled, Before Profit Comes Pain.
That sounds like a philosophical proverb.
It does, but it's deeply rooted in the foundational texts of trading psychology. The sources indicate that the community frequently references the work of Mark Douglas.
Mark Douglas.
Yeah, specifically his concept of the 3 stages of trading pain. He basically revolutionized how traders think about risk by establishing that you cannot separate the mechanical, button-clicking act of trading from the severe psychological burden of risking capital.
I have a hypothesis about that phrase, before profit comes pain.
Okay, let's hear it.
It suggests that you don't actually know if your strategy works. And you definitely don't know who you are as a trader until you have been forced to execute your rules while you are actively bleeding money. Because it's easy to be disciplined when every trade turns to gold. The pain is the ultimate stress test of your methodology.
That is a highly accurate assessment. The pain phase separates intellectual understanding from emotional internalization. You can memorize every single chart pattern in existence, but until you have felt the visceral sting of a 10-trade losing streak, your knowledge is purely theoretical.
Okay, but I have to push back here.
Go for it.
I am trying to think like someone who is highly logical, but maybe new to this specific arena.
Sure.
If these guys are multi-year veterans, if they run VIP groups, if they understand that the market is shifting from a trending regime to a ranging regime,
right,
why just sit there and take the hit? If you see the pain coming, why not just adjust the dials on your strategy?
Yeah.
Like if the road turns to dirt, you change your tires. Why not just tweak the indicators the moment you take the second or third loss?
That is perhaps the most dangerous yet perfectly logical question a new trader can ask.
Really?
Yes. The impulse to change the tires is the exact impulse that leads to the total destruction of most retail trading accounts.
Wait, really? Being adaptable and tweaking your strategy destroys the account?
If we look at the underlying math of statistical probability, over-tweaking is absolutely fatal. Well, to understand why, we have to conceptualize what a trading edge actually is. A strategy is not a crystal ball.
Right, it doesn't predict the future.
No, it's a statistical distribution of outcomes over a large sample size. Let's say you have a robust, tested strategy that wins 60% of the time.
Okay, so out of 100 trades, I will win 60 and lose 40.
Correct. Over a block of 100 trades, 40 of them will be losers. But here is the critical, maddening part.
What's that?
You have zero control over the sequence of those outcomes. The distribution is completely random. You might get 5 wins, followed by 2 losses, followed by 3 wins. Or, statistically speaking, you could very easily draw 10 of those 40 losses back to back in a row.
The 39-day losing streak.
Precisely the environment Deegan Rehab found himself in. Now, imagine you hit a streak where you lose 6 times in a row.
Okay.
If you panic after the 4th loss and say to yourself, this isn't working, the market has changed, I need to tweak my moving average, I need to tighten my stop loss, what have you actually done?
I mean, I feel like I've tried to adapt.
You believe you are adapting, but mathematically, you have just abandoned the statistical model that gave you your 60% edge in the first place.
Oh, wow.
You're no longer trading a proven strategy. You are trading your own anxiety.
Yeah, it makes so much sense.
You're frantically altering the rules to avoid the specific losses that just happened in the past.
I'm curve-fitting my strategy to yesterday's data.
Yes. And by changing your parameters to avoid yesterday's loss, you practically guarantee that you will miss the wins that your original strategy was about to catch tomorrow.
You break the mathematical sequence.
Exactly. This is why the sources are so adamant that accepting losing periods is a mandatory skill. It's not a sign of weakness. It is a required defensive posture.
That makes the chapter title in Vasily Trader's video so much more profound. The outline notes a chapter called Learn to Take Losses.
Right.
He doesn't title it Learn to Avoid Losses. He tells you to literally take them.
He's advocating for absorption. Think of a professional boxer. A heavyweight champion doesn't step into the ring believing he will never get punched.
Right.
He knows he's going to take dozens of hits.
Right. It's part of the sport.
His defense is built around taking those punches on the gloves, absorbing the impact, and maintaining his footing.
Yeah.
But if a novice steps into the ring and frantically runs away, twisting and turning to avoid every single jab, they will exhaust themselves by the second round, drop their hands, and leave themselves wide open for a knockout blow.
That is an incredible way to visualize it. Frantically tweaking your strategy is like running around the ring.
Yep.
It exhausts your mental capital and leaves your account vulnerable to a knockout.
Yeah.
And that vulnerability is the perfect bridge to our next source.
It really is.
Because when the exhaustion sets in, things get dark very quickly. This brings us to the Deegan Rehab channel, which provides probably the most raw, unfiltered look into the psychology of the losing streak that I have ever seen.
His content is a case study in behavioral economics and emotional degradation.
Absolutely. His video is titled, "My Longest Trading Losing Streak, How I'm Surviving It." And the detail that is just seared into my brain from the source notes is that he is recording this on day 39 of his discipline challenge.
I really want everyone listening to truly process that number. Day 39.
It's unbelievable.
That is almost 6 weeks of waking up, brewing your coffee, diligently doing your market analysis, executing your predefined rules perfectly, and ending the day with less money than you started with.
It sounds like an unethical psychological experiment.
It really does. It's a daily exercise in futility.
And he gives this startlingly honest confession about the common causes that deepen a loss streak. He reflects on his past habits, noting that before he started this discipline challenge, a losing streak wouldn't just be a slow bleed.
Right.
It would trigger a catastrophic event. He talks about breaking streaks with revenge trades, or sizing up recklessly, or eventually just blowing up an account and starting fresh.
We need to dissect this downward spiral piece by piece.
Definitely. Let's start with the revenge trade. We hear this term thrown around, but what is the actual mechanism occurring in the brain during a revenge trade?
Well, to understand the revenge trade, we have to look at the concept of loss aversion. Behavioral economists like Daniel Kahneman and Amos Tversky prove that humans do not process gains and losses rationally.
Okay.
The psychological pain of losing $100 is experienced by the brain as roughly twice as intense as the joy of gaining $100.
So our brains are literally wired to overreact to a loss.
We evolved in environments where losing resources like food or shelter meant death.
Right.
So when a trader takes a loss, the primal part of the brain registers it as a physical threat.
Wow.
A revenge trade is pure, unfiltered survival emotion masquerading as a financial decision.
It happens when a trader takes a stop loss. And instead of rationally accepting that the money is simply the cost of doing business, they feel as though the market has maliciously stolen from them.
It becomes personal.
It becomes deeply personal. They want to hurt the market back, and they want their resources back immediately to soothe that primal panic.
Exactly. So they jump right back into the market. They abandon their predefined setups. They ignore their entry criteria. Often they'll trade in the exact opposite direction of the trend that just stopped them out, simply out of spite and urgency.
It reminds me of the worst dynamics you see at a casino.
Oh, perfect comparison.
You see a guy at the blackjack table, he's playing basic strategy, doing okay, but then he hits a cold streak. He loses 4 hands in a row.
Right.
Instead of walking away or lowering his bet, he takes his entire stack of chips and shoves them into the middle of the table on a terrible hand.
Yep.
He's doubling down on bad logic purely because his ego cannot endure the thought of walking away from the table in the red.
That casino analogy perfectly illustrates the second trap Deegan Rehab mentions, sizing up recklessly.
Right.
The desire to revenge trade is almost always paired with the urge to over-leverage.
Let's define leverage and sizing up for anyone not steeped in the math of trading.
Yeah.
How does this actually play out on a screen?
So professional traders operate on strict position sizing based on account percentage. Let's say you have a $10,000 account.
Okay.
A disciplined risk management rule dictates that you never risk more than 1% of your total capital on a single trade.
So if your stop loss is hit, you lose $100.
Exactly. It's a paper cut.
A completely manageable business expense.
But if you hit a loss streak, say you lose 5 trades in a week, you are down 5% or $500.
Right.
For a rational machine, this is a normal statistical drawdown. But for a human brain suffering from loss aversion, the slow bleed is agonizing.
Yeah, I can imagine.
The emotional brain looks at the screen and screams, if I just increase my risk to 5% on this next trade, if I size up and I win, I will make back the entire $500 in 5 minutes.
I can erase the whole terrible week with one click.
Exactly.
And what happens when they click that button? The market moves against them again.
Then the trap snaps shut, because now, instead of being down 6%, they're down 10%. The $10,000 account is suddenly at $9,000. The panic transforms into terror. The trader realizes they have violated their own rules, they're in a massive hole, and the rational mind completely shuts down.
And this is the catalyst for the third behavior Deacon Rehab confessed to, blowing up an account.
Total account destruction.
Yeah.
Accounts are rarely destroyed by a slow, methodical series of 1% losses. It would take 100 consecutive losses to zero an account that way.
Right.
Accounts are blown up because a normal, mathematically predictable losing streak triggers an emotional cascade. The trader sizes up recklessly, loses, sizes up even more in blind desperation, and effectively sets fire to the remaining capital.
But the way Deacon Rehab phrases it in the source notes is, honestly, it's chilling. He says he would blow up the account and start fresh. He presents the destruction almost as a relief mechanism.
It is a dark, perverse form of psychological relief.
How so?
When you're trapped in the anxiety of a drawdown, the tension of trying to trade your way out is exhausting.
Yeah.
When you finally blow the account to zero, you have no money left to trade. The game is over. The agonizing tension vanishes.
Wow.
Starting fresh is the brain's way of finding peace through total capitulation.
That makes the titles of his other videos make so much more sense. He has videos titled, "The Worst Part of Trading Isn't Losing, It's This," and this makes discipline feel impossible.
Right.
He's clearly telling us that the monetary loss is entirely secondary to the mental anguish.
Because a blown account can be refunded. You can go back to a day job, save another $10,000 and deposit it. Monetary loss is temporary.
Right.
But the loss of self-trust is a devastating wound that takes months, sometimes years to heal. When you revenge trade, when you size up recklessly, you're violating a contract with yourself.
You are gathering empirical evidence that you cannot be trusted to act rationally in a high-pressure environment.
Exactly. That is why discipline feels impossible, because you realize the most dangerous entity in the market isn't the institutions or the algorithms, it's your own impulsivity.
Which makes another one of his video titles probably the most confusing thing I have read in this entire stack of sources.
Oh, which one?
He actually posted a video titled, "My Trading Got Worse with Perfect Discipline."
Ah, yes.
Now, hold on. If a lack of discipline, revenge trading, and impulsivity are what cause blown accounts, how on earth does perfect discipline make things worse?
That is a phenomenal paradox, and it gets to the absolute core of why trading is one of the most difficult cognitive tasks a human can undertake.
Okay, I'm listening.
If we synthesize this based on everything we've discussed about market regimes, we can see how perfect discipline becomes a weapon turned against the trader. It comes down to the critical distinction between discipline and adaptability.
Walk me through this. How does discipline become dangerous?
Imagine a trader has spent months building a highly specific strategy. Their rule is, I will only buy gold when it pulls back to the 50-day moving average, and I will strictly risk 1%.
Okay.
That is their discipline. They are immensely proud of it.
Right.
Now imagine a massive geopolitical event occurs. The entire macroeconomic landscape shifts overnight. Gold volatility explodes.
Yeah.
Institutional algorithms completely alter their execution parameters, and that 50-day moving average becomes utterly irrelevant.
The market has fundamentally broken the premise of the strategy.
Exactly. But the trader, clinging to their concept of perfect discipline, refuses to acknowledge the new reality.
Oh, I see.
They see the price hit the moving average and they buy. They lose 1%. They pat themselves on the back for following their risk management.
And then the next day, it happens again. They buy, they lose 1%.
They are acting like a robot.
Yeah. They have confused rigid adherence to an obsolete rule with actual discipline.
They are showing perfect discipline in the face of changing empirical evidence. They might take 21% losses in a row, proudly marching their account into a 20% drawdown, believing they're doing the right thing.
Wow.
Rigid discipline without situational awareness traps a trader in a burning building because the fire alarm wasn't part of their original plan.
So it's like a tightrope walk over a canyon.
Right.
On one side, you have the emotional chaos of revenge trading where you abandon all rules.
Right.
And on the other side, you have the robotic rigidity of perfect discipline, where you blindly follow rules that the market has invalidated.
You need strict parameters to prevent the emotional spiral, but you need enough flexibility to recognize when the underlying math has shifted.
And you have to do all of that without confusing flexibility with the urge to frantically over-tweak your strategy.
It is a profound balancing act. You must be rigid in your risk management. Your maximum daily loss limit is non-negotiable. But you must be flexible in your market expectations.
It is the difference between saying, I will never lose more than 2% of my account today, which is healthy discipline, and saying, the market must bounce at this exact price because my backtesting says so, which is fatal rigidity.
Exactly.
Okay, my head is spinning. Let's ground this back in reality.
Okay, do it.
Day 39. Deacon Rehab is sitting there, walking this tightrope, trying not to revenge trade, trying not to be rigidly blind. How do you actually survive that?
Well, we know tweaking is bad, rigidity is bad, emotion is bad. So what are the actual practical step-by-step corrective actions these veterans employ?
Yeah, let's extract the specific survival tactics detailed in our sources. Starting with Deacon Rehab, his approach to surviving this 39-day streak is incredibly austere.
It is. He describes his method as forcing myself to sit through it, no shortcuts, no tilt, just discipline.
Let's clarify that term, tilt. That originates in the poker world, doesn't it?
Yes. In poker, going on tilt means a player has allowed a bad beat, a statistically improbable loss, to frustrate them to the point where they abandon their strategy.
So they start playing aggressively, emotionally, and sloppily.
Right. By stating no tilt, Deacon Rehab is explicitly focusing on emotional containment.
Yeah.
By forcing himself to sit through it, he is actively engaging in exposure therapy. He is building emotional calluses.
He is proving to his own psyche that he can experience the severe discomfort of a drawdown without triggering the self-destruct sequence.
Exactly. But he isn't just white-knuckling it with pure willpower.
Right. There is a detail in the source outline that is absolutely wild to me.
The AI tool.
Yes. It mentions that he uses AI, artificial intelligence, to help keep his mindset steady when the urge to abandon his plan feels the strongest.
It's fascinating.
I really need to understand this mechanism. How does a chatbot keep a human being from sizing up recklessly? It's not physically locking his mouse.
No, it's not a physical barrier. It serves as a cognitive circuit breaker.
A cognitive circuit breaker.
Yeah. While the outline doesn't provide his exact text prompt, applying what we know about trading psychology makes the utility of an AI incredibly clear. In the heat of a loss streak, a trader's internal dialogue is deeply compromised by adrenaline and cortisol. They need an objective, emotionless sounding board.
Because if you talk to another human trader, they bring their own baggage. They might commiserate with you, which validates your anger, or they might project their own fear of losing onto you.
Precisely. Humans are empathetic, which is terrible when you need cold logic.
Right.
Imagine Deacon Rehab on day 39. He has just taken another loss. His heart rate is elevated. The urge to double his position size and force a revenge trade is deafening.
Yeah.
Instead of acting on it, he forces himself to open an AI interface. He has likely pre-programmed it with his specific trading rules and maximum risk parameters.
So he essentially has to confess his intended crime to the machine before he commits it.
He types into the prompt, I just lost my morning trade. I am frustrated. I see a setup forming that isn't quite in my playbook, but I want to risk 3% on it to make back the deficit.
And because the AI has no pulse, no ego, and no fear of losing,
the AI responds instantly with pure clinical logic. It might output. Based on the rules you provided, entering a trade outside your playbook violates parameter A. Increasing your risk to 3% violates your 1% maximum limit. The statistical probability of an impulsive trade succeeding does not justify the compounded risk of a deeper drawdown. Recommendation: step away from the terminal for 30 minutes.
it is a customized, unbreakable psychological mirror.
Yes.
You literally cannot argue with it because it is just reflecting your own pre-established best intentions back at you.
Exactly.
It really highlights the extreme lengths to which traders must go to protect themselves from their own biology. You have to outsource your rational brain to a silicon chip because your human brain is actively trying to burn your financial house down.
Outsourcing your rationality is a brilliant way to frame it.
It's just wild.
Now let's look at the solutions provided by Rainer Teo. He outlines 3 specific structural concepts for surviving this streak: zoom out, mean reversion, and diversification.
Okay.
These aren't just psychological tricks. These are the architectural pillars of managing a drawdown.
Let's unpack zoom out first. I feel like this is a piece of advice given in almost every high-stress environment, from corporate management to emergency medicine.
Sure.
But what does it mean practically for a trader staring at a screen?
When a trader enters a losing streak, their perspective becomes incredibly myopic. They become hyper-focused on the immediate pain.
Right.
On a charting platform, this usually manifests as staring at the 1-minute or 5-minute time frames. They agonize over every single tick, every single red candle, feeling every tiny fluctuation as a personal attack. Zooming out requires a physical and mental shift in time frame. You force yourself to look at the daily chart or the weekly chart.
I'm going to try a new metaphor here. It's not just the old missing the forest for the trees.
Yeah.
It's more like staring at a pointless painting with your nose touching the canvas.
Okay, I like that.
If you are 1 inch away, all you see is a chaotic, messy, confusing array of disconnected dots. It looks like garbage.
Right.
But if you take 10 steps back, if you zoom out, those chaotic dots suddenly resolve into a clear, intentional landscape.
That is a phenomenal analogy, because the 5-minute chart is the chaotic dots. A brutal, agonizing downtrend that stops you out 3 times on a 5-minute chart might just be a tiny, insignificant, healthy pullback within a massive, beautiful, structural uptrend on the daily chart.
Right.
Zooming out administers a sedative to the emotional brain because it provides structural context. It reminds the trader that the immediate pain they are experiencing is just microscopic noise in the grand scheme of the market's auction process.
Context is the antidote to panic.
I love that.
Let's move to a second concept, mean reversion.
Ah, yes.
This sounds like a statistical law that I probably would have slept through in a university lecture. Why is this critical for survival?
Well, understanding mean reversion is what gives a trader the stamina to endure the pain.
Okay.
Mean reversion is the statistical theory that extreme events, price deviations, or in this context, performance anomalies, will eventually revert to their historical average, or the mean.
Okay, define that for me using a simple mechanism, like flipping a coin.
A coin flip is the perfect baseline. A fair coin has a 50% probability of landing on heads. That is the historical mean.
Right.
But probability does not guarantee sequence. You could flip that coin and get tails 10 times in a row. That is an extreme deviation.
Yeah.
If you don't understand statistics, after the 10th tail, you might panic and conclude that the coin is rigged, the laws of physics are broken, and you should never bet on heads again.
Right. My brain would tell me, tails is hot, tails is the only truth.
Exactly. But mean reversion dictates that if you continue to flip that exact same coin 10,000 times, the extreme streak of tails will be absorbed by the aggregate data, and the final result will be exceptionally close to 50-50.
So how does a trader apply that to a 39-day losing streak?
If a trader has a back-tested strategy with a proven historical win rate of 55%, and they suddenly face an agonizing string of 20 losses, they are experiencing an extreme deviation from the mean. Their emotional brain is screaming that the strategy is rigged and broken. The intellectual understanding of mean reversion is the only thing that allows them to say, this extreme streak is mathematically unsustainable over the long term, provided I do not change my rules.
Wow.
It prevents them from abandoning a perfectly viable strategy right before the math inevitably evens out.
It gives you the patience to outlast the anomaly.
Yes.
And the third concept from Rainer Teo is diversification. Now, typically in traditional finance, diversification means don't put your entire retirement account into one tech stock.
Right.
Buy some healthcare, buy some bonds, maybe buy some real estate. Is he applying that same logic here?
It applies to asset classes, certainly. If you only trade Bitcoin and Bitcoin enters a 6-month ranging regime that breaks your strategy, you are in trouble.
Yeah.
So you might diversify by also scanning gold or foreign exchange pairs like the euro against the US dollar. If one market is hostile to your strategy, another might be highly accommodating.
Makes sense.
But in the specific context of surviving a losing streak, veteran diversification also heavily applies to your setups.
What exactly constitutes a setup in this context?
A setup is the specific rule-based pattern a trader looks for to justify entering the market.
Right.
For example, a trader might exclusively look for breakouts, buying the exact moment a price violently pushes through a historical ceiling. That is one setup.
Right.
Now, if the market enters a choppy, low volatility phase, every breakout will likely be a fake out. The price will poke through the ceiling, trap the buyers, and immediately collapse.
And if breakouts are your only setup, you will suffer a catastrophic losing streak.
Because your one trick is completely incompatible with the current environment.
Right.
Diversification of setups means having a comprehensive toolkit. You have a specific strategy for highly volatile trending days, a different strategy for slow-ranging days, and perhaps a mean reversion strategy for days that just chop back and forth.
So by diversifying your approach, you aren't relying on a single market condition to survive. You smooth out your equity curve and make the inevitable losing streaks much shallower.
Exactly.
So we have Deegan Rehab using AI to enforce his rules, and Rainer Teo relying on statistical laws and diversified systems.
Right.
But the outline points to Vasily Trader utilizing a survival mechanism that is completely different from analyzing charts or math.
Oh, his live streams.
Yeah. His approach was radical transparency. He has chapters in his video titled This Helped and Recovery, detailing how he literally live streamed his entire drawdown.
He didn't turn off the camera.
He relied on transparency in front of his audience to bounce back.
It is an incredibly brave tactic, and from a psychological standpoint, it is a brilliant hack. By remaining entirely transparent, he neutralized the most toxic element of a losing streak, which is shame.
Shame. That is fascinating. Because shame is the exact emotion that fuels the revenge trade, isn't it? You take a loss, you feel humiliated, and you want to erase the evidence of your failure before anyone, even just your own ego, can fully process it.
Shame thrives in darkness and secrecy. When a retail trader is sitting alone in a dark room staring at a red screen, the shame whispers to them.
Yeah.
It tells them they are a failure, that they aren't smart enough. It convinces them to double their position size, take a massive gamble, and win the money back so they can pretend the mistake never happened.
It's the cover-up. The cover-up is always worse than the crime.
By streaming his drawdown live to his audience, Vasily Trader completely stripped the shame of its power. He dragged the failure into the sunlight.
Wow.
He essentially looked into the camera and said, look, this is the unvarnished reality of professional trading. I am bleeding capital right now. My strategy is in a drawdown. And you are going to watch me day by day apply my risk management rules, take my lumps, and slowly, methodically climb out of this hole.
He weaponized accountability.
Yes, he did.
He mathematically couldn't revenge trade because 1,000 people were watching his mouse cursor. If he moved his stop loss out of fear, they would see it. If he sized up recklessly in a fit of anger, they would see it. He turned his entire audience into a distributed AI risk manager.
It is a masterful utilization of social pressure for a constructive outcome. He forced himself to be the professional he claimed to be.
But, this level of honesty only works if you're willing to accept the reality of the market. Which brings us to what I consider the most critical and perhaps disturbing revelation in the entire stack of sources we are analyzing today.
Yes, the contract.
We have spent this entire time unpacking the grounded, agonizing realities shared by Vasily Trader, Rainer Teo, and Deegan Rehab.
We are talking about streaming drawdowns, enduring 39-day streaks of failure, utilizing AI to prevent self-destruction, and the mathematics of mean reversion.
These are heavy, serious concepts. But these videos are sitting on the same platforms right next to some of the most outrageous, unbelievable titles I have ever seen in my life.
The industry illusion. The marketing machine.
Let's read some of these titles directly from the source data because the juxtaposition is just jarring. Right alongside Deegan Rehab's struggle, we have Verified Trader. I took $6,000 to 25 IML breaking the #1 trading rule.
Unbelievable.
We have a video from Ross Cameron titled How I Made $1,000,000 in 51 Days of Day Trading. We even have a video claiming to teach you how to day trade with only $4.
And then you look back at the grounded warnings we've been discussing. Before profit comes pain, the trading industry is lying to you, and World Record Trader reveals the brutal truth you're ignoring.
It feels like two parallel dimensions. One is a gritty documentary about survival, and the other is a Marvel superhero movie where everyone has a superpower.
Pretty much.
If you are a learner, if you are someone trying to genuinely acquire the skill of trading, how are you supposed to navigate an ecosystem that is so heavily polluted with these astronomical extremes?
To navigate it, you really have to understand the underlying business model of the ecosystem itself. The financial influencer space, particularly on platforms driven by algorithmic recommendations, is a massive engine fueled by survivor bias and clickbait.
Let's break down survivor bias in this specific context.
Survivor bias occurs when we only see the data of the winners and completely ignore the silent graveyard of the losers.
Right.
Let's look at the claim of turning $6,000 into $25 million by breaking risk management rules.
Okay.
If you take 10,000 people and instruct all of them to over-leverage their accounts and break every rule of statistical probability, 9,999 of them will blow up their accounts, lose everything, and disappear in total silence.
They will never make a YouTube video about their ruin.
Exactly. But one person, purely through a lottery ticket sequence of statistical luck, might actually achieve that exponential return.
And that one lottery winner is the one who makes the video. And that video gets 4 million views.
The algorithm pushes that video to the absolute top of the feed because it is sensational. It triggers dopamine. It sells the ultimate dream of escaping the rat race effortlessly.
But this dynamic creates an immensely toxic psychological pressure cooker for the average developing trader.
Oh, completely.
Think about the emotional dissonance. Put yourself back in Deegan Rehab's shoes. You are grinding through day 39 of a grueling loss streak.
You are doing the hard, boring work.
Yeah, you are managing risk, taking tiny paper cuts, protecting your capital. You open the platform to look for a video on mean reversion, and the first thumbnail the algorithm feeds you is a 22-year-old standing in front of a Lamborghini claiming he made $1 million in 51 days by trading on his phone.
The psychological assault of that image is devastating.
It would make you feel like an absolute failure. You would look at your disciplined 1% loss, which took immense mental fortitude to accept. And you would think, why am I torturing myself? Why am I sitting here taking these paper cuts while this kid is breaking all the rules and buying supercars? I must be doing this entirely wrong. The disciplined way doesn't work. I need to take massive risks.
And that thought process is exactly how the industry feeds off retail traders.
Wow.
The ecosystem weaponizes their impatience and exploits their envy. It creates a synthetic reality where astronomical, risk-free success is portrayed as the baseline norm.
Which makes the actual reality of trading, which is a slow, methodical, often boring grind punctuated by frustrating drawdowns, seem like a symptom of incompetence.
Precisely.
Which makes a specific detail in the outline regarding Deegan Rehab absolutely explosive. There is a note here about his relationship with a prop firm.
Ah, yes.
For the listener who might not be familiar with the jargon, a prop firm or proprietary trading firm is a company that essentially offers to front you large amounts of trading capital, and in exchange, you split the profits with them.
However, they don't just hand you the money.
Yeah.
You have to pass a rigorous, simulated evaluation phase first to prove you can manage risks and generate a return, and you have to pay a fee to take that evaluation.
Right. So the source material notes that Deegan Rehab was actually cut from the affiliate program of a firm called Take Profit Trader.
He was.
He was a partner promoting their platform, and they abruptly ended the relationship. And the reason he cites for his termination is staggering.
It really is.
He states it's because his content focused heavily on honesty around his own trading, discipline, risk management, and reducing trading stress. The firm reportedly ended relationships with partners whose content didn't align with their brand.
That single data point is an unintentional yet complete unmasking of how certain segments of the industry truly operate.
Wait, I really want to pull on this thread. A financial firm fired an affiliate for telling people to manage their risk and reduce their stress.
Yeah.
That sounds completely counterintuitive. If they are giving people capital, shouldn't they want cautious, disciplined traders?
You would assume so if their primary revenue source was splitting the profits of successful traders. But we have to look critically at the incentive structures.
Okay.
While we cannot generalize every single prop firm, the business model of many operations in this space relies heavily on the constant influx of evaluation fees.
The entry tickets.
Yes. They require thousands of overly confident, underprepared retail traders paying $100, $300, or $500 a month to take an evaluation test that they have a statistically microscopic chance of passing.
And why do they fail?
Because they lack the exact patience, discipline, and emotional control that Deegan Rehab is preaching about.
Oh my God. I see it. If an affiliate is broadcasting the agony of a 39-day loss streak, if he is telling people to slow down, to expect pain, to protect their capital, and to treat the market with deep respect,
right,
he is actively discouraging the impulsive, get-rich-quick gamblers from buying the evaluation tickets.
He is a liability to the bottom line.
Wow.
The firm's brand is literally take profit. It implies immediate, aggressive action. It sells excitement. Deegan Rehab's brand is survive the drawdown.
Right. It sells caution and reality.
When a firm severs ties with a trader for being too honest about the grueling reality of risk management, it validates every single point we have unpacked today.
The actual secret to longevity in the markets is found in the unglamorous, painful realities that the marketing machine actively attempts to suppress and hide from the public view.
That is exactly it.
That is a profound, paradigm-shifting realization, and I think it naturally forces us to completely redefine what success actually looks like in this arena.
It does.
Which leads us to the final stages of recovery discussed by these veterans, the mindset exercises that follow the crucible. Let's look back at Vasily Trader's journey.
Okay.
The outline indicates that after navigating that terrible period on livestream, he eventually hit his best period of the year. But it notes that the best period came only after surviving the worst.
That sequencing is not a coincidence. There is a foundational necessity to that timeline. The best period isn't merely a random stroke of statistical luck that happened to follow the bad streak.
Okay.
The best period is quite literally produced by the psychological resilience and the profound lessons forged during the crucible of the worst period.
How does suffering produce the peak performance?
When a trader successfully navigates a severe, protracted drawdown without breaking their rules, when they take the punches without running away or throwing a wild haymaker, they experience a fundamental, permanent shift in their psychological framework. They no longer fear the market in the same paralyzing way. They know the monster under the bed is real, they've been locked in the room with it for 39 days, and they survived.
Wow.
This survival breeds a level of clarity and emotional detachment that was physically impossible to achieve before they endured the loss streak.
They aren't trading out of a state of desperate survival anymore. The worst has happened, and they are still breathing.
Exactly. Their execution becomes completely objective. And this connects beautifully to one of the most striking video titles from Dig and Rehab's channel.
Which one?
I accepted I might never be a profitable trader. Then this happened.
When I first read that title, I accepted I might never be a profitable trader. It sounded incredibly depressing.
Right.
It sounded like complete defeat. It sounded like giving up on the dream.
To the uninitiated, it sounds like defeat. But within the framework of deep trading psychology, it is actually the ultimate form of surrender. And in this specific context, true surrender is a superpower.
I'm going to need you to connect the dots for me there. How is surrendering a superpower when the entire industry tells you to grind, hustle, and conquer the market?
Because you cannot conquer the market.
Right.
The moment of surrender, the profound acceptance of the loss, the releasing of the desperate, white-knuckled need to force the market to give you profits, is often the exact psychological shift required to initiate a winning streak.
Let's analyze why traders lose money.
They lose because their ego demands that they be right. They want to predict the future. They want to impose their will on a chaotic system.
And when the market inevitably proves them wrong, their ego is threatened, they fight back, and we get the revenge trade.
But when a trader reaches the point where they can honestly say, I accept I might never be profitable, they're experiencing an ego death.
Wow.
They are entirely letting go of the need to be right. They are abandoning the illusion that they have any control over the outcome of the next trade. And once the ego is completely removed from the equation, what is left?
Just the math, just the objective execution of the plan.
Exactly. You stop looking at a chart and saying, this setup must work because I'm smart and I need to make rent this week.
Right.
You start looking at the chart and saying, there is a 60% probability this pattern plays out based on historical data. I will risk 1% of my capital. If the probability fails, I completely accept the loss as a data point.
By letting go of the desperate emotional need to win, you eliminate the very emotional errors that cause you to lose. You return to a state of flow.
You do.
It makes me think of the philosophy behind Zen archery.
Oh, that's a great comparison.
A master archer doesn't focus their mind on the target. If you obsess over hitting the bullseye, your anxiety spikes, your muscles tense up, and your hand shakes.
Right.
The master focuses entirely on the internal mechanics. Your breathing, your stance, the tension of the string, the release of the fingers. If your internal mechanics are flawless, the arrow simply finds the target on its own. The target is a byproduct of the process.
That is a stunningly accurate translation of trading psychology. And it brings us full circle back to Mark Douglas's teachings, which are the invisible thread connecting all of these sources. The paradox of success is that while you need strict mathematical rules to grow an account, those rules are utterly useless unless they are built on a foundational mindset of total risk acceptance.
True acceptance means you do not expect the market to fulfill your personal desires. You simply execute your edge over a large sample size and let the math work.
Yes.
So, if acceptance is the goal, what are the practical daily mindset exercises a trader can use to build that muscle? How do we implement this surrender when the adrenaline is pumping?
One of the most effective, unglamorous tools, which is heavily implied by the discipline challenges these traders undertake, is the strict, unbreakable enforcement of a daily loss limit.
Just a hard physical stop for the day.
A definitive line in the sand. You dictate that if you lose a specific amount, say 2% of your total account in a single day, or if you suffer 3 consecutive losing trades, you are done.
You walk away.
You physically turn off the computer.
Yeah.
You do not look at a chart on your phone. You remove yourself from the environment until tomorrow.
I can imagine the physical discomfort of doing that. If you take that third loss at 10:00 a.m. and you have to shut off the screens while the market is still moving, your brain is just going to be itching, screaming at you to get back in there and fix it.
The withdrawal symptoms are intense. It is profoundly uncomfortable.
Yeah.
But you have to reframe how you view that daily loss limit. You cannot view it merely as financial risk management. You must view it as a critical form of mental preservation and self-care.
Okay. Self-care.
You are acknowledging a biological reality. After a certain threshold of loss, your cognitive function degrades. Your prefrontal cortex, the logical part of your brain, shuts down, and your amygdala, the emotional, fearful part, takes over.
You literally aren't the same person who sat down at the desk a few hours ago.
You are functionally impaired. You are no longer processing information logically. You are reacting to pain. Walking away in that moment is an act of profound professional discipline. You are saving your capital from your worst self.
It's the ultimate acknowledgement that tomorrow is another day. The market isn't going anywhere.
No, it's not.
You don't have to win the entire war by 5:00 p.m. today. Your only job is to make sure your account survives to fight another battle tomorrow.
Capital preservation is always the primary directive. Capital appreciation is secondary. If you preserve your financial capital and, more importantly, your mental capital through the grueling losing streaks, the mathematics of your edge will take care of the appreciation over the long term.
This has been an incredibly heavy, deep dive, but I think it is one of the most necessary topics we could ever cover. Let's synthesize what we've unpacked today.
Let's do it.
We started by shattering the illusion of linear progression. We established the jarring reality that a loss streak doesn't mean you're a bad trader. It is a mathematical certainty like winter following autumn.
Yes.
Even the most seasoned veterans, guys like Vasily Trader, face inevitable periods where market regimes shift and their core strategies just break down.
And we identified that the real danger, as vividly illustrated by Degan Rehab's 39-day struggle, isn't that first inevitable loss. The danger is the emotional cascade that follows it.
Right.
The loss aversion, the tilt, the descent into revenge trading, and the reckless over-leveraging that occurs when you abandon your strategy to try and force the market to refund your money.
The downward spiral.
Exactly.
And the solutions required to survive that spiral are completely unglamorous. There are no secret indicators. There are no shortcuts. The solution is forcing yourself to sit through the profound discomfort.
Yes.
It's zooming out to look at the macro context. It's trusting the statistical law of mean reversion. It's learning to truly, deeply accept losses without shame, even if that means literally arguing with an AI chatbot to stall yourself until your urge to do something self-destructive passes.
And if we abstract these lessons and connect them back to you, the listener, the applications go far beyond just looking at a price chart on a screen.
Absolutely.
Whether you are actively trading foreign exchange, navigating a historically tough, unprofitable period in a small business startup, or dealing with any complex system in your life that temporarily stops yielding results, the core human challenge remains identical.
Mechanics of resilience.
Maintaining your composure, protecting your mental capital, and adhering to your discipline when the immediate short-term data looks absolutely terrible is the ultimate test of human resilience. It is what separates the seasoned professional from the emotional amateur in almost any field of endeavor.
It truly is. Which leaves us with a final, somewhat provocative thought to mull over as we wrap up. We have spent this time dissecting the vast illusions of the trading industry. The flashy thumbnails, the promises of effortless millions, and the pervasive fantasy that we can achieve absolute control over the markets.
Right.
But perhaps true mastery, the kind of quiet, enduring mastery that actually survives a 39-day losing streak, isn't about gaining more control over the external market at all. Maybe true mastery is realizing exactly how little control you have over the chaotic external world and choosing to focus 100% of your energy on the only thing you actually can control, yourself. If you can master yourself, you don't need to master the market. That brings us right back to the pro athlete we talked about at the very beginning. When a pitcher gets the yips, they don't blame the baseball. They don't scream at the wind. They go back to the tape. They fix their own mechanics. They look in the mirror. So if you are listening to this right now and trying to navigate these extremes, we want to hear from you.
We really do.
This is a topic that hits incredibly close to home for anyone trying to build something difficult in any discipline. How do you handle losing streaks in your own trading or in your own high-stress projects? What are your specific, battle-tested strategies for stepping away before you revenge trade your way into a bigger hole in your own life? Let us know.